Welcome back, everyone, to another episode on the Lunar Nation podcast. This is your host, Franz, and I'm joined today by Sagoon and Arrow. Today, we'll be discussing again, how we did last week, in regards to the current state of the market. We'll be diving deep, and as well as what's going on in regards to the financial services sector. It's not about how much money you earn, it's about what you do with that money that matters. Retirement funds are feeling the bear market, companies are pausing hirings, and prices keep on hurting pockets of Americans and people around the world. Nonetheless, certain measures can still be taken to make recessions less likely. As the nation's authority on monetary policies, the Federal Reserve plays a critical role in managing recessions. So the question is, where's the current state of the market heading to, and what are the outcomes for the near future? Okay, welcome back to our audience. Before we start off, I want to introduce. We have a special guest today. Our first guest actually. His name is Matthew. Say what's up, Matthew.
What's up?
Excellent. So Matthew will be joining us today, and like I said, we're going to be diving deep into the market, the current state that it's headed, what companies are doing, what people are experiencing, and how everything's going so far. So, Matthew, why don't you just introduce us a little bit by yourself, what you do, and whatnot? Just a quick, brief, introduction.
For sure. So I'm Matt. I work in the auto industry on the data side. And in my free time, I like to learn more about personal finance, the economy, and just overall how to be better and healthier financially.
Awesome. Well, thank you. I wanna also thank you for joining us today. Hopefully, this topic will bring more enlightenment to our audience, and maybe we can learn more from each other. So, I wanted to start off currently with the state of the market. So I know everyone, we stated in a previous episode that most likely we're going to be heading towards a recession, as many people have stated that, financial advisors and experts. I wanted to talk to you because I know you're very financially literate in regards to like 401ks, Roth IRAs, pretty much like kind of investments that companies do, like employees do with their companies. And I wanted to get your opinion on what you think the current state of that is. I know, not only crypto's been going down, but stocks been going down, and prices increasing. So how do you think that retirement funds are looking like? Are still people scared to invest in their 401k? Or people, saving onto, money personally, or are they still looking to invest, and maybe in your personal experience as well?
Sure. So right now, the S&P 500 and the U.S. stock market in general entered a bear market. That's a 20% downturn. And no, it's down a lot from the 2021 highs. And inexperienced investors are probably pretty scared and maybe, put their contributions down. But how it should be looked at is like a discount, basically. You're buying into the market um, at the lowest point it's been in 3 or 4 years. And if it keeps going down, if we go into a recession and these growth stocks continue to decline from their old time highs, then, it's possible for these people to get in while it's cheap. And I'm sure 401k providers are going to change the makeup of their portfolios. They'll probably move from growth stocks like Facebook, Amazon, Google, Apple, the traditional FANG stocks to more value stocks like um, the finance sector and the energy sector.
Yeah, that no, that's I agree with what you're saying. I just want to add like a quote from Warren Buffett. I think everyone knows about it, but I just want to let people know is what be fearful when there's greed, and then be greedy when there's fear. So basically, like what Matt was saying is that like the stocks are so down right now. There's it's such a discount. It's like going to the store and you're just seeing like 50%, 60% off. Of course, people are gonna be like, "Oh, I want to buy." But right now, just due to the bloody market, people just don't like change. People just don't like to see that negative thing. So they're kind of scared because they feel like it's going to keep going down. So people don't really buy it. However, when there's like a bull market, people are going to go and they're going to buy it up because they see that positive activity. It's just, I feel like it's human nature that is just people that go along with that, right? If they see something increasing, they want to be in that wave, you know. And some people might be caught holding the bag, and hopefully you guys are not one of them.
Thank you, thank you. So Matt, I was so I like how you put it that it's a discounted rate as far as the lowest it's been in like 3-4 years. Do you think that people for the most, do you think like the average person that works at a company that that has a 9 to 5 job, or anyone that's just investing, do you think that because the market keeps on going down, do you think that people are pausing their investments right now, or do you think people are still, dollar cost averaging and still putting money into the market? Because the way I see it is, some people, especially with like prices going up right now, and I know over time, the market has had an upward effect. It keeps on going up and up and up. It's gonna, it beats, it's gonna, turn into like a bullish market and whatnot. But do you think that people wait some time before they start investing again, or they're still, you think they're still doing it on a weekly, monthly basis, just a dollar cost average everything while everything is still down?
Great questions there. So I think it depends on the person's, knowledge on the economy. So if your company provides a match, like on the first 5%, they match with another 5%. Most people would be, they'd be remiss to miss out on that. It's free money. So most people will probably, keep with dollar cost averaging in up to that match, but people might not go beyond that like they were. Um, there's also some tax savings that can be had in this market, in bear markets and in recessionary markets, if you have a taxable account. So outside of retirement accounts, if you have a taxable investment account and your stocks decline, you can actually harvest losses and offset your tax bill with it. So there's some, opportunities to be had in this kind of market outside of the traditional gains that you would look for. But I went back to your original question with the, are people still going to contribute? I think it's going to depend on the person. If they have enough money to cover an emergency and whatnot, maybe they're not contributing as much. Some people may panic when they see their portfolios decline by 18%, 20%. So I think it just kind of depends on the circumstances.
Yeah, I don't know if you guys seen like Wall Street bets. They're like all over Reddit. This is because like Matt was saying about like how portfolios go down 18%. There's people who have like aped into it. That's kind of like a term when they just go and put their entire like life savings into the portfolio, right? And they've gone like 80, 90% down, right? Because they want to make money quick. But in the stock market it's not like that. It's more of a long-term game, because you want to make sure you find the, I would say like company that really has a good long-term future, right? So it's just something that I just want to add, because because there are people with more than 20% loss, 30% loss, because some of them, like you even mentioned, Matt, is they go to the growth stocks, so that's why.
Oh, for sure. Yeah. And I'm sure there's a lot of people taking a lot of big hits on like the crypto market, especially right now. I'm
Oh
sure
yeah.
they're down more than 20, 30,
Oh no,
40%.
no. It's like 80%, 90%, because what it's heading to is it's a bear market, right? So it's really crazy, and I feel like the worst is yet to come, unfortunately.
You think that it's still going to get worse,
Oh, I
Sagoon?
do, I do, I do think it's going to get worse, because we're not even close to a true bear market in crypto. I mean, we can do a whole different topic, like podcast about crypto as well, but just want to let you guys know that, and the audience as well, that the worst is yet to come, because we're not even close to finishing the cycle. This bear market could last, in my opinion, from maybe over 1.5 years.
Okay.
So
I see.
just
I
don't be
see.
optimistic. Don't be optimistic right now that you see that Bitcoin is hovering around 20K and Ethereum's around 1200. Don't be optimistic, because there are, from my opinion, I think the worst is yet to come.
Okay, cool, cool. Well, what about I wanted to talk more maybe to Arrow or Matt. Do you think that, I know Sagoon said that it's going to keep on going down, but do you guys think that the market is going to still, is going to stabilize shortly, or do you think it might still be going on a downward trend for a while?
For the general market, I think it's going to seesaw back and forth and then continue to go downward as the Fed raises rates. because I think that the Fed's going to have to raise rates higher than it thinks it's going to have to. We're probably going to see interest rates enter, 4% by the time we're in 2023 to tame inflation. And that we haven't seen that since, it's been decades. So people are going to panic. They're going to, get into different assets that will have returns outside of growth.
Like commodities and bonds, things of that nature, or
It's going to be, so bond prices move inversely to interest rates. So they'll go down as interest rates go up, but the amount they pay out will go up. So depending on if you're a retiree, you get more money like from the bond and fixed payment, but it's worth less. So your portfolio in general will be worth less. But
right?
like
Okay,
typical, like, the stocks that, Warren Buffett was mentioned earlier, the stocks that he typically invests in that are value oriented, we'll see a lot more attention instead of, the, the, the company that you think is going to 10x, the company that's taking in loss after loss every quarter, but with the expectation of lots of profit in the future, those won't get as much attention as the safe bet
I
in
see. I see.
2023.
But I know that if the Feds start raising interest rates, won't that lead to like a full blown recession? Because from what I know, if the Feds keep on rising the interest rate, that will technically lead to a recession. Am I right or am I wrong, or is it kind of like a gray area?
It's kind of most of the time it results in a recession where I think it's defined as 2 quarters in a row that the gross domestic product contracts. So that could definitely happen, but it's not going to be anywhere near as bad as, 2008 or even the dot com bust. It's, a lot of the fundamentals are different.
Hmm.
People have more cash, they have like emergency reserves. So we'll go through a recession. There may be some layoffs. I know one thing that Jerome Powell was hopeful of, that since there were so many job openings that weren't being filled, a lot of that, a lot of the results of the recession would just be companies closing down those open positions. So that's kind of the best case scenario. The more typical case is that unemployment will go up to like 7%, 8%, whatever, and we'll
Right,
go
right.
through a year long recession or something like that.
I see. I see. It's interesting that actually you mentioned as far as companies cutting some of these vacant jobs or whatnot. I know actually Arrow knows a little bit more. Wanted to discuss a little bit more in regards to what's happening with these companies and their employment situation.
Yeah, so I see a lot of posts on LinkedIn, especially of like just recently I just came across a post with Tesla. They did lay off more people. The thing that's kind of unique is the people that are getting laid off more are like the recruiters, the HR entry level people, specifically software engineers whose position just got rescinded. And the coin, I mean, we did talk about Coinbase and different crypto companies that are also laying off. What I'm finding unique is I've came across an article where a hedge fund personnel said that it's more going to be affected to the white collar workers, and the blue collar workers are more going to be safer because they're more skilled. So it's this kind of recession is kind of targeting more of the white collar workforce, and it's quite interesting to see like how these companies are strategizing and letting go of people. Most importantly, like, I don't know if you guys heard, but I know Elon Musk has a goal to lay off 10%. So they're like one of the ways he's trying. I mean, I wouldn't say he, but Tesla, they're tracking the amount of hours you're in on site, And I guess if you're not on site as much, that could be a red flag, and that will give him an excuse to pretty much let you go. So it's kind of evident in the market that the tech industries are more of the hard hit sectors within the job market that are being let go.
Got you. Okay, so what you're saying is basically the white collar jobs are going to be much more affected in the recession than blue collar jobs or blue collar workers. Is that correct, Arrow?
Well, that's not what I'm saying. That's just the articles I
Well,
came
I mean,
across.
from what you explain, I'm not saying that you
Yeah,
stated it, but just
yeah,
basically from what you've read or from what you're
yeah.
seeing,
Because I'm
that's
seeing on LinkedIn, like people saying I'm open for the job market. Some people are leaving their job because their job necessarily wants them to be on site 5 days a week. So they're leaving for those reasons. Some other people are being let go because of unforeseen circumstances, especially because if you noticed, a lot of companies hired more employees than they needed. So those people that are newer in the industry are the ones who are targeted, and most importantly, are the ones who are let go, even regardless of how they performed, if they did
Also,
phenomenal or not.
Also, Arrow, I just want to add as well. I know you said the new employees as well, but I also feel like even the older employees too that are making a lot of the money, right? Because the company's trying to cut size, and when they're trying to cut size, get like the people at the top, in my opinion, are the ones that are gonna take the hit because they want to balance the budget, right? They want to make sure that they can get as much money as possible saved, so I just feel like, I mean, even the like you said with the entry levels, it could be because they're hiring as much people as possible, right? They kind of over allocated, in my opinion, like all these like car companies, GM, Ford, even Tesla, as you can see, right? But I just feel like just due to the fact that people with a lot of experience are holding, like, let's say they're making like 200-300K right per year. I feel like they're going to be the ones that are going to be axed because the company wants to save more money.
okay. So, well, I know in a previous episode when we talked about it, we stated that people that are contract position are usually the first to go and whatnot.
Yeah,
People that
yeah,
are
no,
newer.
that's
So what do you guys think? So, I mean, or also, what do you think, Matt? Is it true that people that are like that have been with the company for like 30, 40 years and are making a large sum of money? Do you think they're like their jobs might be on the line, or is it just because the company's trying to save some money and cutting the people that have the biggest income will help them reach their goal, or is it just it just depends on the case of the company, and everyone's different.
So a lot of times, what will happen with those employees is the company will offer them like a buyout package. You'll get like a year's salary plus your retirement if you're eligible for retirement. Otherwise, like not yeah, it was GE and IBM did this before too. When they had a large proportion of their workforce was older, they would buy out employees who were not eligible for retirement and get them a package and send them along, or they would buy them out and then the employee would take retirement at that time if they were eligible for it. Um, but like an employee in their prime earning years, like 40 to 50, they're not eligible for retirement. Um, I haven't seen as much of that. I've seen it a little bit, but mostly it was like unrelated to the economy. Like most economy related cuts have been, contractors, um, people kind of fresh out of college or new to the company, new to their position, things of that nature.
People with like less experience and whatnot, right? Usually like the fresh meat.
Yeah, yeah.
I see. Okay. Okay.
yeah.
So yeah, what were you saying, Zagon? You
No,
wanted to
I
add
was
something?
I was gonna say, I mean, that is an interesting take as well, because from my perspective, I was thinking more of, the older people, right? Because that's kind of what, like, my former company that I worked in did. But I also do see your point that, contract workers are gonna be the first one to take an axe. So then I guess after contract workers, then it would hit the full time people. But then within the full time people, I believe that people with like more experience, like, who are taking more of the budget would take the hit. But that's just kind of my perspective. due to like the how the company operates in the first place, right? You don't want to just take out like, I mean, like young people, right? They want to focus on the future. That's just me.
Okay, I see. Were you saying something, Big Matt?
So I have a
Yeah.
question.
Oh, oh, sorry. I was just going to say real quick. A lot of what will happen with those more experienced employees is if there's redundancy, that would be a point in which case they would get cut.
Yeah, that's true. um, so I have a question. Do you think this like whole Ukraine Russia situation, especially with like the oil market and gas prices going up, had a significant impact, or we would have regardless faced this recession to this extent, even if they didn't invade?
So that was more about like the Ukraine war, right, influencing the recession. Um, I think there was pieces of it that did influence it. A lot of the you know, not tariffs, but like embargoes on Russian goods and oil. But there was a lot of stuff even before the war and invasion that kind of, hampered uh, the economic growth in the U.S. And like some of it, like especially on the supply side, wouldn't have changed. Like oil has been trimming down investments. The oil industry has been trimming down investments in new wells domestically, uh, especially with a lot of rhetoric from from politicians saying we're going to bankrupt you, whatever. Um, so that kind of led to a lack of supply and that supply side shock when the invasion started. So it was kind of multiple factors at play there. I still think there would have been a recession, but maybe it wouldn't have been quite as severe as if Russia hadn't invaded Ukraine.
Got you, got you. I think Arrow might have something to say, but real quick, Matt, do you think that because I mentioned in a previous episode that I learned how the within the last 2 years, United States printed 80% of their currency, so I think it was at like 4 million, and then that ended up being 20. I mean, not 4 million, 4 trillion, and within 2 years they ended up printing a total of $16 trillion, making the total $20 trillion. So did that amount of money that they printed over the last year and a half to 2 years, would is that also an effect that did play on the market right now, or like the incoming recession that we're seeing?
So that's more of an effect on the inflation side of things. So, more money in the market means each dollar is worth less than the previous dollar was. So that definitely did,
Right.
hurt
Like,
things.
because like I'm saying, because I know they're always printing money, but the fact that they printed, I think, like a vast amount. Like I said, I think it was 80%. They printed 80% more than, because we were at 4 trillion from I think from statistics it was around like 4 trillion in 2020. And then obviously pandemic hit. I think they were trying to boost the economy, but they ended up printing like over $16 trillion. So I understand, it's at like inflation, but do you think that they, because they printed like so much, that it had such a big hit on the inflation that started causing like kind of like a trickle down effect, or is it just it wouldn't have made that big of a difference?
So, um, a little bit of A, a little bit of B. So there was some pressure already. So there was people sitting at home and people with money were spending it anyway. They were buying stuff instead of services. So inflation related to physical things and the supply side to those things was going up. And then, the government sent out stimulus. So people had even more money. Some put it in the stock market, but most people, they wanted to entertain themselves. They bought computers, TVs, game systems, and that, the supply side shock hit the semiconductor industry, um, and forecasts on the supply side were wrong, and that caused a lot, to happen on the supply side, which caused inflation to go up because of the few, semiconductors, cars, physical things that were there produced were worth more because they were scarce relative to demand from the people sitting at home who wanted physical stuff. And now people are kind of out and about. They want to travel. We're seeing inflationary pressure on services, travel, uh, like hotel stays,
Hotels and like
tourist industry.
transportation and things of that nature.
Yeah, so I think we're gonna, that the dollars that were funneled into the economy, they kind of pressured up inflationary pressure. There would have been some, maybe it wouldn't have gone quite as high, maybe like 6% instead of 8%. It just exacerbated, the situation more.
So it definitely seems like the recession. How long do you think it would take for the recession to fully take effect on people? Would it take a year, 2 years, or are we seeing that slowly trickling down right now?
So I think we're starting to see it. Or, well, I mean, we're starting to see people react to the, possibility of a recession where companies are rescinding offers, people are starting to save more than they spend. Um, but there hasn't been any layoffs yet. It's just that the thought process is already there. And most CFOs throughout the country think that there will be a recession in early 2023.
Hey, Matt, I just had a quick question for you. So basically, do you think it's going to be as bad as 2008, or do you think that it might not be that bad, or it might get close to it, Because everyone's always scared of that 2008 recession when, all these companies had to be bailed out by the government, right? So I'm
Everyone's scared all the time. Everyone seems to blow things out of proportion sometimes, but that's just my opinion.
No, I mean that is true though, because of all the media, right? The media did make it a huge deal because of what
Yeah,
happened.
it's just like I'm gonna let Matt talk, but it's just kind of like FOMO, how like what I mean when like Lucid was going up in price, or Ethereum or Bitcoin were growing up in price, and people just kept on buying it. And they were buying all this hype, but at the end of the day, you know what I mean. I mean,
It's always
there's always gonna be a recession.
there
It's
is
just,
there
what I
is
mean. It's gonna be different every single time. So I don't think it's
yeah.
gonna be as bad. But yeah, I'll let Matt take over. I didn't want to cut in too much.
For sure. No, you're right, Franz. It's not going to be nearly as bad as 2008. The fundamentals are far different. What caused 2008's recession was a bunch of subprime debt being sold back and forth between banks, and then people were defaulting on that debt, became junk status, and then from that point it became like a snowball that just kind of grew, and all these firms went under along with a lot of homeowners. Here, the average person financially is on better footing, as is most corporations. They kind of know what's coming, whereas last time it was kind of like a shock throughout the economy. So this time, people and corporations are going to have time to prepare, and they have better financial footing relative to 2008.
Right, right. Yeah, I completely agree with you. I wanted to talk to you, Matt, a little bit about um, if you happen to know a little bit about what's called stagflation. I know the last time it really hit hard here in the United States was, I think, in the 1970s. So basically, if the audience doesn't know, stagflation is a combination of slow economic growth, ongoing layoffs. Now, I know, and then high inflation, which we're experiencing high inflation. We're experiencing a slow economic growth. As far as layoffs, I know we did talk in a previous video how a lot of this, people in this generation or in previous generation, but there's a lot of people, resigning from their jobs that, they're work eligible. But now we're also seeing companies taking on this approach of pausing, their hiring process, or maybe laying off, a few thousand or a few, a couple percentage of their workforce. So what I wanted to ask you, Matt, about stagflation, I know, like I said, I know the last time I think the United States saw it was, in the 1970s. So it's a combination of like the, layoffs, high inflation, slow economic growth. Do you think that, I know you said this recession might not be as bad, but do you think that we're going to have a combination of all these three might make it a little bit worse than, people might expect, or is just, something that is going to be normal to see?
So what happened in the 70s, and I believe the Fed chairman was Alan Greenspan during that period. We had such high inflation. Like it was in, 15,
Yeah, between
16,
I think
17%.
14 to 60, maybe 17%. It was around that range. It was double what it was now. You were right.
For sure. So what happened was Greenspan and the Fed at the time, nobody really trusted that institution at the time because the institution, the Fed, they were not raising rates to combat inflation. So when Greenspan took over, he aggressively raised interest rates. Like Jerome Powell raised interest rates at the June meeting by 75 basis points. That's nothing compared to what Greenspan did. So we had a decade basically of very high interest rates. So debt was very expensive. You had to do really weird financial games to get a loan for a house. My father, who lived through it, told me a bit about it. He was in real estate at the time, so it was a little interesting. Um, so debt was very expensive. There was no wage growth, and there was high unemployment. So usually, unemployment and interest rates move in opposite directions. Uh, and when they don't, you have these odd situations like stagflation, right? So, um, as inflation was, as it came down, Greenspan was also able to reduce interest rates. And the interest rate hiking is what causes the recession. Um, so the point here, like in today's time, we'd have to see very high interest rates for a prolonged period of time, which would coincide with the recession for us to have stagflation. I don't really think that'll happen for a sustained period of time, if it happens at all. I don't think we're going to get above 5% interest rates. We had 10% interest rates at least in the 70s.
Oh yeah,
So,
for
yeah.
sure. It's just one of those things, right? I mean, but what about like if there's like any like war or something, right? That's something that we can't really control. Like I feel like if we do have some kind of like negative effect of, maybe another country taking over another country, right? I think that could still cause like the economic downfall as well. But I like you said, Matt, it's like we're hoping that it doesn't go up above that 5%, and just like in the 70s, hopefully we don't have that, that extreme interest rate hike. So that's just kind of the viewpoint. So it's just basically like we just have to have some kind of like change, immediate kind of change, right? Some kind of like, I don't know, like an
I
emergency
mean,
plan.
it's not going to be immediate change.
But I mean,
I think
yeah,
Matt can. I mean, just the way how everything has played out and how
yeah,
it plays out in past cycles. I think it just takes time for it to all take effect. It's not something that's going to happen within a week or a month. It's probably going to take. I mean, what does
years.
it usually last? Like a year,
You think
maybe 18
years?
months.
So I mean, that is a good point, but it's just like I still do feel like at the current rate that we're going in right now, I mean, who knows what Jerome Powell will do next, right? I mean, we can't really predict it, right? We're just saying that we hope that it, is under 5%. So yeah, like
Right.
you said, it might be, it might.
Hopefully,
I'm just hoping for things to get better. I want to be optimistic. So let's not talk too negative.
for sure. I'm pretty sure everything's not going to be as bad. Real quick, Matt, just to get your last thoughts. I mean, in your opinion, I know we covered a little bit about the retirement funds, inflation, the recurrent market, and whatnot. So, in your opinion, it does seem that from what your stance is that we most likely are going to enter in a recession. So, you're thinking it's not going to be as bad, but typically, do you think how long is it going to last in your opinion if it's not going to be as bad?
Yeah, I mean, what you said before, a year to 18 months is about right, um, depending on circumstances of, in the economy. Like what happens with Ukraine and Russia won't really impact us as much. It's more shock value. People sell stocks and go into bonds because they're scared. But the economy wide recovery, with things being as they are, I don't anticipate it taking too long. I think the economy would recover before the stock market would, though. I feel like it would be a lot slower recovery than we had, in that huge jump in 2020 to 2021 once people just started, retail investors started pushing into the stock market and driving prices up. I think it'll be a slower, gradual stock market recovery, but the economy would recover quicker.
Awesome, awesome. Well, we really appreciate your insights, Matt, and appreciate you taking the time out of your day to come and join us on this podcast and giving us your thoughts. I want to thank the audience for joining us today. Whenever you have a moment, be sure to like, comment, rate, and subscribe to our episodes. Comment if you have any other thoughts on what else you'd like to hear. And just like always, we'll see you next time. Take care.